Hello everybody, this is Eddie Ghabour with Key Advisors Group. I wanted to send this video out today to kind of talk about some of the things that we've been doing from a firm and allocation perspective, but more importantly, why we continue to have such a strong conviction that we are right. And so we know in this business, there's no such thing as being right all the time. We know that. You just need to have a very good batting average. But there are certain times in market history where when you were to look back, hindsight, as they say, is 20/20, and you look at the signals and warnings the markets were giving you, you can kick yourself at times for not making what would have been at that time seem like a more obvious trade or trend, but you just didn't go with it. Okay, so I want to stress again the reason why so far our market call has been very accurate is back in November we started to give the warning signs to our clients, as well as during our national TV interviews, on the fact that we were heading into a slower growing economy. Okay? Understand, in 2021, the economy was accelerating on growth. Inflation was starting to accelerate. And that was what we would like to call as the beginning phase of an economic acceleration. And that's very good for risk assets. That's why you saw the high risk in companies with not strong balance sheets do better than what I'll call your boring, more staple type companies. But now the game has changed, okay? And I can't stress this enough. In my opinion, if you have not de-risked from the high beta plays that you had in 2021, you're going to get whipsawed in 2022 if we are correct in our market thesis. And look, it's very clear. Since November, we've seen some pretty big drawdowns in a lot of these high-risk stocks already. So you may be asking yourself, did I already miss it? Are you going to ride it more farther down, or has it bottomed? And look, at the end of the day, no one truly knows the answer to that. That's why when it's risk management time, you need to incrementally, in my opinion, lower risk when the signals tell you to. And I think it's crystal clear that the Fed is going to be raising rates, and the economy is slowing down, and inflation is a problem. Those three things are extremely bearish, in our opinion, when it comes to the equity markets and the high-risk markets. So, in our opinion, it is not too late to de-risk, because we think the most problematic time period could potentially be the second quarter of this year. And I want to do the best I can in educating everyone so that way you don't get hurt. The bottom line is you've had a tremendous year, hopefully, the last 2 years in the market when it's gone basically straight up. And from a timing perspective, as they say, buy low, sell high. So from a timing standpoint, even if we didn't see these warning signs, you never go broke taking a profit and rotating out of your higher risk plays and kind of booking some gains. But when you take a look at the layout and the setup, I've been doing this for 20 plus years. This is one of the most bearish short-term setups that I've seen because of the massive bubble that was created because of our government. And the inflation number, it's higher than we've seen in a long time. So the Fed is in a tough spot. I don't feel bad for them because they put themselves in this spot. But the bottom line is they're forced to tighten regardless of whether the economy is decelerating or not. And so when the Fed tightens during a deceleration of an economy, it's ugly. Look at 2018, the fourth quarter. It's a very similar setup, except even worse, because we are going to have comps that earnings and economic data is going to get compared to that you just can't compare it to because they were so high last year, okay? So again, comps are going to be horrible, in my opinion. Inflation is going to stay sticky. The Fed's forced to tighten, and the economy's slowing down because the consumer is getting crushed with the high cost of food and gas, and the list goes on and on. One last thing that I don't think anyone is really talking about enough is how much lower government spending is going to be in 2022 than was originally anticipated because of the fact that D.C. never passed the bill. The Build Back Better bill that they were supposed to pass or said they were going to pass, it was going to put all these trillions of dollars into the economy, didn't pass. So when you take that out of the economy, there's a risk that we could see a deceleration of GDP at a much higher level than what many people are anticipating. And if we get that on top of a Fed being aggressive in their hikes, that's when you get the 20 to 30% drawdowns in the broader markets. And look, I'm not saying this to scare you. I'm just stating what I believe is the setup going into 2022 as we are now getting each day closer and closer to that second quarter. So please, evaluate these warnings or setups that I'm sharing with you. Take a look at your portfolio and ask yourself, is the risk tolerance that you have right now suitable for what you want for you and your family? And if it is, then obviously you make that decision whether you need to make any changes or not. But at least I know I did my job of hopefully educating you as to why we see the setup as being challenging. So we're not just saying, lower risk without any reason. We are giving things that we feel are going to be the setup that actually will happen this year. And so I'd rather play a little bit more cautious for 2022 as we look into a Fed tightening in one of the toughest time periods to be doing that here in recent history. Okay, so thank you for your time. Please subscribe to our YouTube channel for educational videos that we try to push out every single week to try to help everyday investors make sound investment decisions for their family. Thank you. Have a great day.